How do you do, ladies and gentlemen? I'm your host, Seth Julian, welcoming you to today's morning brief, where we're going to discuss day 3 of the earnings report season. It ain't looking so good. The big banks are weaker than expected. What I've drawn here is a chart that shows the S&P 500 index on a yearly basis, and it's a huge data set. It goes back to the 1870s, but we're only going to keep a look on this, since the 1980s. This is the interest rate, U.S. interest rate over time, and this is just the NASDAQ that's superimposed over that to give us an idea. And these are the volumes in the force index for the S&P. Just to parallel the S&P and the NASDAQ, that's for comparison purposes. And what we're seeking to do is compare and illustrate that as the interest rate goes to zero, the market explodes. This is the decline after the Great Recession in 2007, of course, and this is after considered January 12, 2012, when the recession is considered to have been run its course, and now we're in the huge recovery, and this is a 250 odd percentage rise in the S&P, but the interest rate is going to go up soon. This has been risen largely on this no inflation, cheap money economy that we've been living in, and that, well, I don't want to go into excessive detail about the political economics of that economy, but suffice it to say, it looks like it's about to change. Interest rates are going to rise quickly and sharply. We don't think the Fed is going to be wimping out. We think they're going to be serious and raise interest rates shortly. And as those interest rates rise, as the old saying goes, those who've been swimming without a bathing suit will become clear as the tide goes out, meaning that as interest rates rise, companies that have been making money and making profits by using other people's money and borrowing are going to find that model more tenuous because it's going to cost more money to borrow. It's going to cost more to borrow cash. So, ladies and gentlemen, that's going to wrap it up for now. Keep our eyes on the earnings report. They're continuing to look weak. The interest rates are about to go up. Think about liquidating some of our stock portfolio holdings. Thanks, and trade with confidence, ladies and gentlemen. Bye-bye for now.